Standard Chartered presents CNBC-TV18 Leadership Collective. We are meeting in a city that has always been more than just the capital. It's the corridor where policy ambition meets enterprise execution. Accounting for nearly 6% of country's GDP, Delhi has become a proving ground for both national ambition and global resilience. This is a place where India's leaders are forging new economic blueprint, both in policy and in business. And the results are tangible. Delhi's GSDP has demonstrated remarkable strength with 99.16 real growth for the last fiscal year and per capita income surging over 7% year on year. This success is not by chance. It's driven by a dynamic startup ecosystem that has grown over 15% this year, solidifying the city as a global innovation hub. This energy is now backed by clear policy vision, the new draft Startup Policy 2025 and its 200 crore VC designed to fuel the new era of entrepreneurship. Tonight, we are here to understand the strategic thinking behind this growth. We'll be in conversation with leaders who are defining what it means to lead in this pivotal moment, anchoring new era of growth, and charting fresh corridors of opportunity. Thank you for being with us. Now let's start this power-packed evening. What awaits are multiple insightful sessions. We're living through contradictions. Unicorns rising, but fundings are falling. IPOs breaking record, but exports facing tariffs. The world's largest youth population, but a deficit of patient capital and skills. For some, this looks like turbulence. For others, it's a perfect storm that forces leap forward. The question is, will India's decade forward in the growth will be built on hype cycle or on resilience, deep tech, and power of new talent? To lead this conversation, may I please invite on stage Shireen Wan, Managing Editor, CNBC-TV18, and to help us decode where the opportunity lies in this push and pull, please welcome two leaders who have been in the core of India's growth story and have read India's market structure up close. Sanjiv Bikhchandani, Founder and Executive Vice Chairman, InfoEdge India, and Ashish Dhawan, Founder and CEO, the Convergence Foundation.
Good evening, ladies and gentlemen. It is a pleasure to welcome you all here to the CNBC-TV18 Leadership Collective. It's great to host you all here in the national capital with two quintessential Dilliwalas. It doesn't get better than Sanjiv Bikhchandani and Ashish Dhawan. Gentlemen, thank you very much for braving the traffic, the rains, and for joining us here this evening. The conversation tonight is going to focus on, of course, what we're seeing happen globally at this point in time with the many pulls and pressures, the contradictions that Shivani spoke about. But we want to focus on what India is good at and what India must prioritize at this point in time. And these two gentlemen have been perma bulls on India for the last 4 decades. They've put their money and their mouth betting on the India story. So Sanjiv and Ashish, without further ado, let's get started on the India thesis at this point in time. Sanjiv, from your vantage point, not just at InfoEdge, but from the many companies that you invest in, 140 companies at last count, including the multi-baggers like Zomato and Policy Bazaar, how would you size up the India opportunity today?
So look, I'm an India optimist, primarily because India is all I know, okay? And I am an optimist. I've never invested outside India. I'm a founder of several businesses, so I know startups, or I think I know startups. I like to believe I know startups. I may be right, I may be wrong. And therefore, we invest in startups. And we've done 140, and some have worked, and some haven't. But I do believe startups will take India forward. The startup ecosystem is buzzing. It's never been better. There are enough very good founders who are trying, many more than there were 25 years ago. Or 35 years ago when I started out. The quality of the founders is also, I think, a lot better than it was 30 years ago, 35 years ago. Their ambitions, their audacity, their vision, it's significantly different. There is now funding available. There's a whole ecosystem to mentor them, to help them. the market is much larger than it was 35 years ago, and therefore the opportunity is larger. So I'm an India optimist for all these reasons.
No, I get the fact that you're an India optimist as well as an opportunist in the right kind of way. But if I were to ask you to spot trends for us at this point in time that you believe are at the cusp of breaking out, what would those trends be?
So I'll tell you, we don't do top-down investing. We don't do macro and then decide where to invest. We have an investing team of about 20 people. We look at about 1,000 startups a quarter. We invest in about 4 or 5. So we do it bottom up. Right? Now, if somebody had told me in 2010, invest in the restaurant listings category, there was no category.
Yeah.
Right? We just met Dipinder. We liked what he was doing. We said, okay, this could have legs. Let's back him and see what happens.
Yeah.
Right? So we invest very often in category-creating companies. And the risk is slightly higher there, but the payoffs are also larger. And, if you're an innovative first mover, I think you have some chance of success. There's risk. But if you are a follower, I think you have no chance of success.
No chance of success, at least not in the market that we are in today. I'll come back to you on your deep tech bet, Sanjiv, because that's a big change for you as well. But Ashish, let's talk about the India story and how you size up the opportunity. I mean, beyond the cliches of this is India and this is Bharat and, where the twain shall meet. But how would you look at the trends, what they're telling you, and where the money is then going to flow?
Yeah, so if we put aside some near-term challenges, I think the trends are generally very positive. We have a banking sector that's in great shape. We have a government that I think seized off this ease of doing business and deregulation. It's a big push now, which is a huge, it has levied huge friction costs in India. We've grown at 6-7% despite regulation and despite how difficult it is to do business in India. So if we can change that, I think we can grow at 7, 8, 9% going forward. There are near-term challenges with the US trade deal, etc. But I think once that gets solved and we open ourselves up to other markets, as Sanjiv said, I think with startups now, there's a more competitive, healthy ecosystem in India. Companies are becoming more productive as well. So I'm a Burma bull, as you said, an optimist. And I actually think we will grow faster after this challenging period of the next year. We're already growing at 7.8%.
7.8, that's the latest GDP print. And of course, the expectation is that the government will move the needle on deregulation, on GST reforms, the meeting currently underway. And that should push at least engines of growth on consumption and, of course, investment forward as well. But, both of you talked about the ecosystem developing, and specifically relevant to the startup ecosystem is the fact that domestic pools of capital have been unlocked specifically in the last few years. I mean, Zomato, for instance, foreign ownership, now domestic ownership. Zepto, again, making it a point to say that, look, we have domestic ownership, not foreign ownership. How does that change the game, Sanjiv Bikhchandani, the fact that you now have large pools of domestic capital that are available and patient capital as well that's now available?
So there's a difference between public markets and private markets. So in public markets, there is substantial domestic capital along with foreign capital. Okay, and therefore a Zomato can get to 51% or more, 55%, perhaps 54% domestic ownership. It is helped by the fact that we own 12-13% and InfoEdge, and we are an Indian company. Yeah. In private markets, early stage risk capital, venture capital, while the amount of domestic capital has increased substantially in the last 10, 15, 20 years, aided in no small part by the government's 10,000 crore fund of funds in 2016, and now topping up of that for a second fund of 10,000 crores. But still, maybe more than 80% of risk capital is foreign capital. Because, early stage venture capital is not an asset class which traditionally institutions and HNIs and individuals in India and family offices have put money in.
Yeah. Is that starting to change, though?
That is starting to change. I think people have seen how at least some investments have succeeded. So let me put it this way. So the InfoEdge market cap is around 90,000 crores. the value of our holding in Zomato and Policy Bazaar is more than half of that, right? Now, that sort of thing, when it happens, I think people begin to notice. So now we are seeing a lot more domestic capital, coming in, but it is still dwarfed by foreign capital. Venture capital traditionally has not been a big asset class in India, but hopefully it's going to change.
Hopefully it is going to change. Are we starting to see signs of that? I mean, it led to a debate a couple of months ago where Uday Kotak lamented about the fact that you now have more family offices and the next gen wanting to run family offices as opposed to wanting to run actual operational businesses. Has there been a change in mindset and mentality as far as, domestic capital and those who can put this capital to use is concerned, Ashish? What do you see today?
I think right now, the public markets have been so good over the last 5 years that family offices are making a very handsome return, just investing.
Why run businesses? Just run a family office.
Yeah. So exactly. And I think that, look, everything works in cycles, but right now there's an upcycle. And therefore, even when you look at private investments where you lock up your capital, is it really going to deliver a higher IRR? Is questionable. But that's a phase in the cycle. I think more importantly, there's been a lot of liquidity generated because of the bull market. Lots of promoters have sold a portion of their stake, have set up a family office. That family office has started investing. So I think over a longer period of time, they will look at riskier asset classes. And so venture capital is likely to get more money over time, but it'll take its course. It's not going to happen overnight.
No, it's not going to happen overnight. Sanjiv and I were having a conversation not very long back, and he's a self-confessed darpok. Now, he says he doesn't like to take risks, and that almost seems contrary to what he's just been talking about. But Sanjiv, your bet on deep tech, because again, there's question marks on whether India has the prowess. Can India really do deep tech? And I know that we are starting to see signs of deep tech companies being built out of India. Your bet through InfoEdge Ventures on the deep tech ecosystem. Take us through that.
So I'll tell you, I have a hypothesis. In early stage investing, startup investing, you've got to invest today in a sector, area, company that is not fashionable, because then you get in at the right valuation, but the company and founders have to be really good. And then if things turn out your way, then the herd follows. Maybe after 2 years or 3 years. So you got to be there before the herd comes. When the herd comes, valuations go up, you get a great return. So can you predict where the herd will go and then go there before? So that becomes one key thing. And there are a lot of hit and miss, trial and error, luck, you get it wrong. We got lucky in Zomato that we went there into Zomato in 2010 and we were so low in the first 4 rounds. And then, the floodgates opened of capital, and suddenly they got as much capital as they needed and wanted and more.
Yeah.
Okay, and now I haven't checked last week, but last time I checked, the market cap was over 3 lakh crores.
Over 3 lakh crores, that's correct.
So you got to go in early. You got to stay the course. You got to demonstrate commitment and faith and keep on investing. And you have to be right.
Is it a bittersweet moment though? 90,000 crores for InfoEdge and over 3 lakh crores for Zomato.
Yeah, that's okay. That's okay. We win either way.
You do. It is a win-win either way. But Ashish, the deep tech story that's playing out. We've just got Semicon 2.0 at Yashobhoomi, which is currently underway. We launched India's first indigenous chip, and we'll have the METI secretary here in a short while from now talking to us about that. How do you play this deep tech story? Do you believe that beyond the government backing, support, subsidy, what have you, that, private capital is likely to venture into this area?
Yeah, I think initially government support is critical and it can help crowd in private capital. I think the semiconductor is a great example where because of the center putting up a huge capital subsidy and then state governments also, that really you only had to put in a quarter of the capital. And that's what brought in private capital and then joint ventures and other things. PLIs played an important role in initially getting assembly, but also pushing up the value chain with components now in electronics. I think this RDIF that government has announced, the 1 lakh crore fund, will be a game changer in terms of stimulating through a fund of funds, deep tech funds, because we really don't have deep tech funds in India. And some of the existing VCs will start to have a higher percentage of their portfolio. And I think money will then create supply as well. People coming out of PhD programs, people who are founders teaming up with them. I mean, you already see some buzz in a few spaces, but I think that supply is still small.
Yeah.
And that could change in the next 5-10 years. If you look at China's example with biotech, they were non-existent player 10-15 years ago. And now they are forced to be reckoned with in biotech. I mean, one reason why biotech valuations are so low in the US is because of competition from China. And I think India, with a concerted push, could get there in 10 or 15 years.
Is this where the herd could possibly be headed in the next 5 to 10 years?
See, I'll tell you. Actually, I didn't answer your earlier question, so let me answer that first on being risk averse. See, we've done about 300 to 400 crores, maybe 500 crores of investments in early stage deep tech since 2019. So we were one of the early people, and at that time, when we first went into it, it looked like it might be foolish because nothing was happening there. Suddenly it's red hot, right? But risk averse, our Zomato and Policybazaar shareholding is worth 45,000 crores, 50,000 crores. Deep tech, we've done 400 crores.
Yeah.
That's 1%.
Yeah.
So we are risk averse. I am a darpok. If that was the only money I had, there's no way I would have done it. Right?
Yeah.
Okay, so number one. Number two is we had a leader in the company who was a former CTO of InfoEdge, and he said, "मैं बोर हो गया हूँ, मेरे को कुछ और करना है." So I said, "ये कर लो." And we allocated a small sum of money, and he began to potter around. And he loves technology, and he goes so deep into it, and he began to read scientific papers and began to find labs in universities in India where stuff was being done, reached out to them, and invested in some 28 deep tech companies till now. Now, at least 8 to 10 of them have got follow-on rounds now, all in the last 12 months. That tells me the market is hotting up for deep tech. Now, deep tech is not one technology. Deep tech is 50, 100 different technologies, which are bundled under deep tech. Basically, a rule of thumb we have is, if it requires a PhD to understand it, it's deep tech.
If it requires a PhD to understand it, it's deep tech. Fair enough.
And the day it doesn't require a PhD, which means it's got commonplace, it's all over the place, it's no longer deep tech.
It's no longer deep tech, and the herd would have already been there. Yes,
and I think, Shireen, one sign that's not talked about enough for deep tech in India is actually not from the startup ecosystem. It's from a large company, Glenmark.
Yeah.
With a novel drug now getting a $700 million upfront payment and a $1.225 billion contingent payment.
And it's taken 20 years. It's taken 20 years in the making,
But the fact that you could have this is a huge category.
It is.
And a novel drug that's really beating the other drugs in terms of the readout is very significant.
See, that's the other point. If you look at the US, who funded the LLMs? Who's funding deep tech? The point is, deep tech very often takes 15, 20 years, 12 years for gestation period. The life of a VC fund is 10 years, 12 years. So deep tech is not a category that's naturally suited for a 10, 12-year VC fund. Which is why company balance sheets, where the view is in perpetuity. They can hold forever, right? Those are more useful. So it will be the Reliances, it will be the Adanis, it will be the Mahindras, it will be the Bhartis, it will be ONGC, NTPC, BHEL, people with big balance sheets who can invest big in LLMs. ये सब innovation वहाँ से आएगी. VC cannot be expected to sustain 15, 20-year gestation periods.
No, I agree with you, and I think perhaps one of the arguments at this point in time is that should people with large balance sheets, the TCSs and the Infosys, have gone down that road and done much more of that kind of investment?
Only if it makes business sense. See, every company will do what makes business sense. I mean, ITC could do it. It's got a large balance sheet, but only if it makes business sense.
I think, Shireen, with tariff barriers likely to come down, and India's more open economy. Earlier, you could live behind...
You mean our tariff barriers likely to...
Our tariff barriers.
Yes.
Whatever deal we sign, I think, with the UK or elsewhere, I think as our market opens up more, companies will be forced to invest more in R&D because that's the only way they can compete in global markets. And that's around the corner.
But, you know, in hindsight, the Indian IT services companies over the last 3-4 decades have made so much money, so much cash. If they had put it all behind these digital tech startups, they would mostly be Indian-owned. They would not be foreign ownership, and they would not be dependent on so much on foreign capital.
Yeah.
And the shareholders of these IT companies would have made a lot more money.
And I think that begs the question on capital allocation. I mean, how much do you reward by way of dividends and share buybacks? And could you have actually allocated more to investing in the likes of Zomato and made a killing? Or perhaps, that could have been a possibility.
So look, I mean, you got to invest behind growth. And either your current business is perpetually going to grow and you're convinced about it, but when you lose your growth, you lose your PE multiple. Okay? So therefore you've got to constantly invest behind growth and innovation, and that could be inside your company, it could be outside your company, it could be both.
I think also, Shirin, if you study economies around the world, R&D investment really kicks in around $3,000 per capita.
Yeah.
In China, you saw it in 2000 to 2020, corporate R&D went up 100 times from a low base. I think India's at that point now where markets are going to open up. You know, to traverse middle income trap, you need to invest in R&D. And global giants, if you want to create global giants out of India, it's on the back of R&D. So I think all of that is going to change in the next 20 years.
Well, you know, speaking about the next 20 years, and I know that's something that both of you are heavily invested in and believers in, is also India's talent and human capital. And both of you are co-founders of the Ashoka University. Ashish, I'll start by asking you, we're talking about the big GCC boom here in India, driven by Indian capital, human capital and Indian talent. Are we ready to keep servicing the needs of the future in an AI, ML world? Are we ready? Are our educational institutions ready to train human capital for the world that beckons us?
Yeah, I'm not as worried. I mean, of course, we need to prepare ourselves. I think demand creates supply, is my own sense. I mean, when the IT boom happened, you had 5,000 engineering colleges come up, and NIIT and AppTech, and supply responded very quickly. So my own sense is now that there is demand. Supply is responding very, and it's not just universities. It's online programs, it's corporate training programs. It's a variety of different things to upskill people.
What's been the most challenging, but also the most gratifying aspect of building Ashoka over the last 10 years?
I think it's just that, India is still a country where the best universities are yet to be built. And so there's the opportunity to do something different, interdisciplinary, and, really show that you can create good private universities alongside leading public institutions.
How do we build institutions that will ensure that Indian students don't have to go to all kinds of places to get an education and, in fact, get the education that they want right here in India? Affordable, good quality.
So look, quality does cost money in education. I think what you want to ensure is enable access, that those who can't afford high fees must get financial aid. So what we follow at Ashoka is that admission is on merit, financial aid is on need. And we try and ensure that nobody who is offered admission in Ashoka says, I cannot attend because I cannot afford it. Right? But having said that, look, India is a country of 1.4 billion people, many, many very young people. The kind of capacities you need are very, very large to service this population. And one Ashoka won't do it, but look at it this way. The private sector responds very fast, public sector less so. Why did NIIT and AppTech come up? So I finished college in 84. I think NIIT was founded in 82 or 83,
yeah.
Right? Why did it come up? It's because the public system did not introduce computer courses. And here was this private organization saying, you do this course, you get a job, maybe. Right? So it's an essential skill. And people began to, and you got a public company out of it. Right? How did why did so many, so India's IT boom was not built by the IITs, because IITs there were only 5 IITs at that time, now there are more.
Yeah.
It was built by the 3,000 or 4,000 or 5,000 private engineering colleges that came up, because IITs succeeded, IIT graduates succeeded, their graduates were in demand. There were more people applying for IITs than there were seats. Private engineering colleges came up to cater to that demand. So the private sector responds, private markets respond. What you need to do is ensure quality.
Yeah, and that is going to be critical as we move forward. Let me end by asking, and Ashish, I'll start by asking you, you talked about the opportunities, both in terms of what the government needs to prioritize, as well as some of the big risks that you foresee outside of course, the US tariff issue and the geopolitics. What would you sum up as the key opportunities and the key risks, and the one big takeaway from your own career as an investor and as an entrepreneur that you'd like to share with us this evening?
So I think the big takeaway, I'll start with that first, is just long term. Don't separate the signal from the noise. India is a growth market. You should obviously be cautious at periods of time, but long term, be positive, be an optimist is very important. And the best opportunities come when there is this short-term pessimism, in a sense. I think as far as the opportunity for the country is concerned, I think we do very well when we have our backs pushed against the wall. And this is a great opportunity to reform, do the big 2.0 reforms that have been waiting to happen. Whether it's this national manufacturing mission, whether it is deregulation, whether it is, R&D stimulus by government, GST. So there's a whole host of 8 or 10 big bang reforms that we really need to do now, and that will propel us forward.
Well, that certainly is on the agenda at this point in time, and you're right. I think everyone is in agreement. Never waste a crisis, and this is one that India most certainly should not. Sanjiv, risks, opportunities, and the big lesson that you'd like to leave us with.
I think, I think it's good that the government is emphasizing manufacturing. I think it's good that a lot of the media is saying manufacturing. But let's understand one thing. So when I was in college in Delhi University in the early 80s, I studied economics. If I remember correctly, the share of services in India's GDP was 20-something%. Now it's 60%?
Yeah.
Why has that happened? It's because we have a natural affinity for services. It's our strength. Okay? This 7.5% or 7.8% growth has come because of services.
Yes.
So while it's important to push manufacturing, understand that your natural strength is services. So don't ignore that, because that is what is delivering results right now. Manufacturing may take 10 or 20 years to deliver results. So services ko bhulna mat.
Bhulna mat, I think that's absolutely right. And the needle hasn't moved very far as manufacturing is concerned. For over a decade, we've been talking about getting to that 20% plus share of manufacturing, and we're still stuck at under 15% at this point in time. So very, very wise advice there. Services ko mat bhulna. Sanjiv Bikhchandani and Ashish Dhawan, many, many thanks for joining us here on the Leadership Collective. Thanks very much for your time, and thank you for joining us with your incisive ideas on the India growth story. Ladies and gentlemen, a big round of applause for Sanjiv Bikhchandani and Ashish Dhawan. Thank you so much. Thank you.
Thank you, Mr. Bikhchandani, and thank you, Mr. Dhawan, for your time. Thank you so much, Reen. From investor flows to policy cues, we now have the framework for India's next big leap. While our last session focused on where the capital flows, this one is about how companies will scale. In this environment, enterprises must think corridor by corridor and how to expand beyond metros, how to embed resilience into their supply chains, and how to balance strategy with sustainability. That's the backdrop for our next conversation with a leader who has balanced everything from FMCG, agribusiness to hospitality and digital infra under one umbrella. Ladies and gentlemen, please join me in welcoming Mr. Sanjiv Puri, Chairman and Managing Director, ITC Limited, and request Shireen to please join us.
to have you join us here in Delhi. He doesn't spend a lot of time here anymore now that he's not leading CII, but I know that through the course of his CII tenureship, he was spending a lot more time here in Delhi, so we do miss having you here in the city. But, you know, we're talking about global uncertainty, and of course, we're all accustomed with the term VUCA world, but you have your own coinage, Sanjiv, and I want the audience here to pick up on what you believe is your philosophy. That's TURN: turbulence, uncertainty, rapid change, and novel strategies. Take me through what TURN is about. How are you using TURN to steer and navigate ITC through this period of turbulence and uncertainty?
Thank you, Shireen. It's always a pleasure to be on your, interact with you. So, TURN really reflects what's happening in the world. We have this business about geoeconomics, geopolitics. In fact, if we look back and see from the time we had COVID, it's been events and events. And then we have climate crisis, which was always there, but it's got more severe. It's right on the face right now. We have also the large changes that are happening on account of technology. AI is another chapter that's opening up, and all this is happening while social inequity is rising. I think the market is also getting transformed. Market is getting transformed because on one hand we have new marketplaces getting created, like the quick commerce and so on and so forth. On the other hand, consumer trends are changing. You have the millennials, you have the Gen Zs, their outlook and their needs are evolving, and their voice is being felt now. And regulations are also shaping products because of sustainability. So things are changing quite fast on account of many of these issues. And coming to the second part of how do you really embed this in enterprises. So at the end of the day, I think it's back to basics. But right now it's really I would say the agility and the rigor of some of these facets that change. So to my mind, three, four things are very important. Portfolios need to be contemporary. So portfolios need to transform much faster than they ever did.
Okay.
So you need to be, and in ITC we talk about not only trying and scaling up the core that we have or using the core to address adjacencies, but continuously looking at vectors for the future. Like in the paperboard business, sustainable packaging is a future vector. So that's a continuous process, because that is what will take over in a much shorter time than it ever happened before. And to do that, I think investments in R&D have to go deeper.
What is the current R&D investment that ITC is doing? And I know that this has been something that has been part of the culture and the DNA at ITC for many years now, Sanjiv.
Okay, before I come to that, let me just finish the last leg of this. I think the third aspect that is very important is the aspect of resilience in supply chain. And resilience because of trade-related issues, trade-related barriers, geopolitics, and resilience also because of climate change. You can have one supplier somewhere, I think it was in 21 or 22, when the water levels in the Rhine River went down and people could not transport. So if you had a supplier there, your supply chain would be disrupted.
Right.
So your supply chains have to be, so I think these three are the facets that are very important. Now, R&D for us is very important. In many of the categories that we are there, we are challengers. So we realize we cannot just succeed by, doing the same thing. So innovation and differentiation is very, very important for us. And we have a large R&D center at Bangalore. We are incidentally some years back, a private research identified that the ITC Life Sciences and Technology Center was the largest private sector innovator in India. And we are, of course, not in the kind of sectors where R&D index is of a very high order. We are not in those kind of sectors. Yet, we were classified as the largest private sector innovator. Now, you had an interesting debate just a short while back on deep tech and balance sheets, etc. So, yeah, there is some stuff that happens in our R&D which I don't understand, and you need PhD, so I don't know whether it is deep tech.
It qualifies as deep tech or not.
But what I can say is that, in our research, there is stuff that takes 5, 7, 8 years to come to the table. Even when I'm developing, plantations for our paper business, which are disease resistant or weather resilient, by the time the whole thing gets commercialized is about a decade. So there are long-term investments there. When we made chocolates, it took several years to get something that was, we believe, better than what is available in anywhere, right? We launched a brand recently called Right Shift, which is for people above 40 years. It's nutrition-dense products with proprietary extracts. This has been in the offing for several years. The solutions were there. I think we were waiting for the right time, and I think this was the right time, so we brought it into the market. So there is a lot of work happening on R&D,
So
and long-term also.
Enough patient capital at work.
Yeah, there is no hesitation from investing that. I think it's about citing the opportunity and the business case, and we remain committed to that.
Sanjiv, talking about citing the opportunity, let's talk about the big change that everyone is anticipating. And of course, that meeting is currently underway, and hopefully we should have clarity by tomorrow on which way the GST Council votes as far as GST rates are concerned. But the assumption is that for a large part of your portfolio, which is in the FMCG space, there are going to be significant reductions. I don't know about the cigarette basket. That's a different story altogether. But from the FMCG point of view, from a consumption, larger India consumption point of view, what could this potentially mean? What kind of unlock do you anticipate?
So I think this is a very bold step that the government has taken. It's the Honorable Prime Minister announced it on the Independence Day, and I think it's going to have multi-dimensional impact, because it's not just about rate reduction. It is also about simplification. It is also about ease of doing business. So the changes are multidimensional, and impacts are going to be even more profound. I think it's certainly going to make things cheaper for the common man. So it will fuel consumption. It will lead to a lot more formalization of the economy. It's going to make life simpler for corporates, for MSMEs to comply with simplicity in structure, and some of the processes, etc., getting streamlined. So I think it's a significant step forward, and it will remove a lot of friction and provide good momentum to the economy over a period of time. Yeah.
But, in terms of, I understand taking away the friction, which is to do with the compliance-related procedures that we expect the government to act on, and I believe some of those decisions have, in fact, been cleared by the GST Council today. But on the consumption momentum, given the reductions that are expected, are we expecting a big pickup? Because that's the expectation, that if there is any potential revenue loss, it'll be made up by a boost in consumption. What are you working with? Because for FMCG, the last several years, volume growth has remained largely flat. Do you believe that this could be the kicker that you were waiting for?
I think it'll be a very significant intervention to grow volumes. If we step back and see, in a country like India, where the penetration levels are low, per capita consumption is lower, why is it that consumption has been slow? I think it's simply because of the elevated table of costs. Between pre-COVID and today, things have changed. A lot of factors are external, and the other factor is to do with climate change and food inflation, which has been sticky. So in a common man's budget, you see, food is a significant part of the wallet, and that inflation has been sticky. So that's the reason why the consumption, we believe, has been under stress. But now that, if with the taxes going down, prices are going to go down, I think it's going to make a significant boost to consumption. Also, and it's not just one step, interest rates have eased. I think fortunately the inflation is also under control.
Yes.
The experience in the recent past with farm incomes has been better. So a lot of factors are coming together, and this is going to provide, I think, a significant more impetus.
A significant impetus, that is the hope. But on cigarettes, what's the expectation? There is a demerit slab of 40%. Do you expect that that's where it will hold, or that's where you will find yourself? Or do you anticipate that there could be more cesses and levies on top of that?
Well, I was just waiting for that question. So you see, I am very well informed by what is stated in media. So I guess you know it better than I, but my understanding is that, what our expectation and understanding from whatever I'm reading is more that it's revenue neutral. What percentage will be here, what will be in some other form, or what will go back to, some other form of taxation to make it, how the split will, bucketing will happen. I mean, I can't really comment. That will be very speculative.
Yeah.
But that's what we hear, and that's what we hope and believe will happen.
Well, the expectation is that it will perhaps be status quo in terms of rates. We may, in fact, see a higher incidence. I don't know if the demand for an additional levy that many states have moved to cater to revenue protection, but one will not speculate on that.
Historical data has shown that actually does not lead to revenue protection.
Yeah.
It leads to revenue depletion.
Because
of the
illicit market picking up. But, we talked about consumption. Let's talk about investment, because one of the peeves of the government has been that we haven't seen private investment, private capex picking up, despite the fact that we put lots of sweeteners and sops on the table. But in the case of ITC, you are actually putting money into investments. You've got a 20,000 crore rupee capex plan for Bharat, so to speak. What are you seeing as trends on the investment side from an ITC perspective as you build out for the future?
So we are very optimistic about the potential in the Indian market for the reasons I alluded to, the headroom to grow. At the end of the day, the economy, despite all the global challenges, Q1 was 7.8, which is brilliant, and we have been, the forecast are around 6.5 or so. So it's a significant growth there, and that opens up many opportunities. And that is why we are investing that kind of money. Although we are not in I would say, a capital intensive sectors, though paperboard a little bit, but others are not that capital intensive. But still we are putting that amount of capital because of the opportunities we see in FMCG, in agriculture, in paperboards, and tourism. So all of these sectors have enough headroom to grow. If I was to just give you an example of paperboard itself, we are the fastest growing market on paperboard. Of course, we do have challenges right now of dumping from some countries. Leaving that aside, as far as domestic demand is concerned, we need to add about 1 million tons every year. That's the potential. And this has huge multipliers on the economy because you're actually empowering all the wood to fiber value chain, right? So there is huge opportunity, and that's why we are investing behind this. And we have some new verticals also. We've started the food tech business. We've started sustainable packaging, which is a development around our packaging business itself. We've also started work on biological extracts. So all these areas will require investments.
Speaking about the multiplier impact as well as your future investments, tourism is the big unlock that the government is hoping will also drive both investments as well as consumption, will also be a big job creator and a job generator. And I would imagine that one of the reasons for the demerger to finally take place as far as ITC Hotels is concerned is the fact that you finally saw this opportunity kind of unfolding and opening up. Where do you now see that business over the next 5 to 10 years, Sanjiv?
So I think from India's development perspective, you're very right. Sectors like tourism are very important. There is this whole concern on AI and automation and all of that. So some of the real brick and mortar business models is where a lot of jobs can come. So tourism is one. Agriculture is a very big one. Wood-based industry. So all of these are important areas. And tourism, certainly there is a huge potential. And we decided to, of course, demerge because there was potential.
Yep.
And our businesses had matured to a level where it could, stand on its own feet independently. And when we were, talking about listing, which is we listed just about some months back, we were talking of 200 hotels. Now in the last presentation, it's already 220. So obviously, the target needs to be substantially upped. We should be, it's 220 for 2030. but I think we should exceed that far more. We will set a new target soon because the headroom is huge. See, our rooms per thousand is 0.3. Globally is 2.2. And the many of the steps that the government is taking to promote tourism some are in place, some are in the making.
Yeah.
So all of this is really going to fuel tourism, not only in metros, not only in leisure destination, tier 2, tier 3 towns. So huge opportunities will come.
I can't let you go without giving us that headline. When do you announce that new target for the hotels business? If it's not going to be 220, it's going to be 220 plus. When do you announce that new target?
Oh, we should do it sometime, maybe when we make next year's plans, etc. We'll change it that time, yeah.
You know, new opportunities. We just finished talking to Sanjiv Bikhchandani and Ashish Dhawan, and they're big supporters of the Indian startup ecosystem. But I don't know how many of you know that ITC is equally a big supporter of India's startup ecosystem because they're actually going and acquiring some of those D2C brands that have come up, and you've done a bunch of them. What do you see from a value point of view? How value accretive is this going to be? Are these acquisitions going to be for you in the next few years, Sanjiv? What's the thesis there?
So, as I said, the consumer market is transforming. And while we are scaling up our core and using the core to address adjacencies, but there are newer spaces that are emerging. And those such important spaces is where we are making the acquisitions to strengthen our portfolio, where we believe there's going to be a huge tailwind in future. So if you look at the sectors we have gone for, behind health and wellness. So Yoga Bar is a premium healthy products portfolio, everything natural. We've gone to a 24 Mantra, which is an organic brand. Organic has got a huge future. We've gone then also for Mother Sparsh, where consumers are today looking for specialized solutions in areas that are important for them. So baby care is a very, very important subject for the mother. So she's looking for specialized solutions, natural solutions. So that's where Mother Sparsh comes in. Frozen again is a category. It's a galloping category. It's going to become huge in future. So that's where Prasumma came in. And it's not that, we are building this portfolio inorganically and organically. So whilst we have done this inorganically, organically we launched a brand called Right Shift, which I spoke about.
Yeah.
We launched a brand called Prana, which is for aromatherapy and wellness. So
how much of all of this wellness stuff are you using? As a CEO today, having to deal with all kinds of uncertainty, how much of your own wellness stuff are you using, Sanjiv Puri? Aromatherapy every night?
Every day in the office.
Every day in the office is aromatherapy, is it? Yes. What essential oil are you using to keep the stress away?
So these are earth-inspired ingredients. So these are formulations that are nature-based and actually give you the aroma that can keep you a little calm and peaceful.
We could all collectively do with some calm and peace. But you talked about the changing Indian consumer, and I think most businesses are grappling with the changes that we're seeing in the consumer market. What are the 2 or 3 big shifts that you're seeing? One, of course, I think what quick commerce has done is just disrupted fulfillment expectations. Now everybody wants everything in 10 minutes. What are some of the other big shifts that you're seeing in the in the consumer market?
So I think I alluded to some of the important ones. One is, of course, lot more niches are developing. Lot more niches are developing because the model of, the go-to-market model for the consumer is such that a lot more variety is accessible to the consumer, and therefore a lot more niches are developing. And the areas where niches are developing are areas of health and wellness, areas related to nutrition, areas related to hygiene, areas related to beauty, areas related to things like baby care that I spoke about. And these are the areas that are evolving. At the same time, there are markets that are evolving in the luxury and premium segment, which were missing from India. I think India is maturing as a market. These segments are evolving. And on top of it, because of the advent of D2C, the advent of e-commerce, segments are also getting far more competitive. So that's the kind of transformation. A lot is happening in that sense.
A lot is happening, but are there profits in the niches, Sanjiv?
Absolutely, yes.
There are?
Yes.
At this point in time?
You see, you have to bet for the future. These are some of the niches are categories of the future, so you have to invest for the future. So you have to, when these categories get scale, yes, the returns will be there. Yeah.
What about global aspirations? And, we're all talking about Make in India brands going global across different categories. How much of that is something that ITC is working towards over the next 5 to 10 years?
Yeah, so far, I'll confess we haven't done too well at that. We've been more India focused. But we are starting to make our presence felt outside of India. I think in FMCG, the first step was to establish distribution setups in various countries, which has happened. We are exporting to 70, 80 countries now, and we are starting to invest. We are also starting to develop focused approaches in some countries. A small one, we've started with proximal markets, and then we will go beyond that. Similarly, in hotels, we have taken the first step in Sri Lanka.
Sri Lanka, yeah.
But yes, over the next 5 to 10 years, this is definitely on the agenda. This is one area that we haven't done too much, but it's a big opportunity for us, and we will pursue it. Yeah.
So besides going global, which you've identified as a priority or area over the next 5 to 10 years, what would the other top 2 priorities be for you that you intend to focus on with a laser-sharp eye? Well,
I think we have opportunities in lot of sectors that we are into. So we will continue to focus on building the portfolio in each one of the sectors, so that not only we partake in the markets of today, but we are also building our portfolio for tomorrow and day after. So what happens when you are chasing the quarterly numbers or the yearly numbers, the tomorrow and day after gets forgotten.
Yes.
So this is an area that I'll really spend a lot more time, that every business of ours is building a portfolio for tomorrow and day after. And if you look at agriculture, we are talking of attribute specific, sustainable, value added. We are talking about biological extracts. Paperboard, we're looking at plastic substitutes. In FMCG, I already spoke about many of the things. So that's the kind of focus I'm going to be having. And the second area that to do this is going to be around innovation, our capability to innovate, capability to bring better solutions to the market. And the last one, it's actually 3, which I spoke about also in the beginning, is about making sure that our supply chains are resilient. There are too many risks to the supply chains. Trade barriers, climate emergencies, disruptions, extreme weather events. So these are 3 areas where we will be putting in a lot more focus.
Yeah. This is the Leadership Collective, Sanjiv Puri, so I'm going to end by asking you, distill for us the top lessons that you've learned over the last few years of running ITC, that have helped you navigate the uncertainty and the difficult times, the ups and the downs.
Okay, let me put it in 2 buckets. One is I'm a firm believer on what we call the 3 V's: vision, vitality, and values. And in large organizations, or for that matter, any organization, I think people really engage and give their best when they see the castle that is being built. If they only have a line of sight of their activity, the level of engagement is not that high order. So everybody must align with the vision. And in today's world, we need a lot more empowerment, because the circumstances are very dynamic, fast changing. But when you empower people, of course, you need to define degrees of freedom, but there has to be something that is guiding everybody forever, and those are the values. Those become very important. And in our case, if I look at one very strong facet of our value, and I think that has deep impact in the way that we work, is this whole belief that businesses have both a social and economic purpose. And businesses are, after all, economic organs of society. They are, in a way, we say, trustees of societal resources, social, environmental, and financial capital. And its trusted role is to preserve and nourish them. That's the role of trustees, right? And that is what guides all of our actions. That's what guides all of our actions with responsibility. And that's what creates the value of trust within the organization. So trusteeship and trust go hand in hand. And as a leader, you need to instill trust. You need to earn your trust. And that flows from the whole principle of trusteeship. And when there is trust, I think people also align with the vision well. So you can have a vision if people don't trust leadership. And when I'm saying leadership at various levels, the alignment may be in form, not in spirit. So these are important facets to look at. And when we are looking at the third aspect of vitality, I think one is the piece on empowerment, I think, which is very important, which I spoke about. Secondly is to have a clear set of directions or strategic directions which are very simple and clear on how the organization will grow and how the organization will remain competitive. So that's where, the definition of portfolio, and that's where the definition of the competency areas or capability areas to invest in, like, innovation I spoke about, digital is another, and so on and so forth. That's very important. And teams must have access to the resources they need. We can't expect people to innovate and create the best products if we do not have that R&D center which is world class.
Yeah.
Or you cannot be cutting edge in digital if you don't have the cutting edge skills, talent, and the resources. So these are, it's just these building blocks need to come together. And that's what I believe in, and that's what I focus on.
Well, since vision, vitality, and values, the three V's that you spoke about are in place at this point in time, and you spoke about being category creators, but also looking at opportunities of the future. Leave us with what could potentially be a category that you hope to get into, that you hope to disrupt, or you hope to create?
Well, there are several categories that we are, which we are looking at. Now, for competitive reasons, I don't want to name too many of them.
Okay.
But one area certainly that it's a well-known, area, and I think India needs a lot of it, and India needs India-centric solutions, and I think that's the area of proteins.
So proteins, that is going to be the category that ITC intends to disrupt as the next big thing.
In future, yes. In future, yes.
And
because we want to create an Indian solution. We want to create an Indian solution.
And that's where the R&D kicks in as well. But when you talk about the future, are we talking about a few months? Are we talking about a year? Are we what are we talking about?
Future, this will require, when we are trying to create a unique solution which is India specific, it will be a medium-term effort. It's not going to be a 2, 3, 4 months or 1 year effort. It's going to be a medium-term effort. You can't create disruptive solutions in 3 months and 6 months. And you have to be patient.
You do have to be patient. What is the one thing that's most exciting to you today as far as the India story is concerned?
I think what is exciting to us is that there are very strong structural drivers in India, a huge amount of opportunities, and we have a government that has, of course, done a lot of things and has very clearly stated the intent to do a lot more. And the first demonstration is the GST. I think that really adds to the excitement and dynamism in India. That's what excites us.
Sanjiv Puri, a pleasure speaking with you. Thank you very, very much for joining us and giving us a very broad and comprehensive look into what is happening at ITC, what's shaping the future of ITC, and what's shaping the future of India. Truly appreciate your time. Ladies and gentlemen, a big round of applause for Sanjiv Puri. Thank you very, very much for joining us here this evening.
Thank you, Shireen. Thank you.
Thank you, Mr. Puri, and thank you, Shireen. We've looked at capital at scale, and now we turn to the glue that binds them both, finance. As global tensions rise and US doubles tariffs, trade routes and risks of being reciprocal in real time, yet amidst this turbulence, new lanes are accelerating, particularly between nations of Global South. To understand what this means for capital, compliance, and confidence, please welcome P.D. Singh, CEO, India and South Asia at Standard Chartered for a fireside chat, the Corridor Code, Banking the Global South with Shireen Bhan.
Thank you very much for joining us here at the Leadership Collective. They are our hosts this evening, so a bigger round of applause should be guaranteed. P.D. Singh, thanks very, very much for joining us here. You know, a lot of the conversations that we've had so far continue to focus on the changing dynamics that we're seeing, whether it's tariffs or it's geopolitics. What does all of this now mean as far as trade in itself is concerned? We've talked about the possibility of significant deglobalization, or now as it's being called reglobalization. P.D. Singh, how are you looking at the evolving situation and what it eventually means?
Thank you, Shireen. Lovely to be here in Delhi today, this evening, despite all the rain.
They're making you feel right at home.
Absolutely. Mumbai is exactly, was exactly like this. Global trade is completely disrupted. We're living through a complete historic change in the way lines have been drawn. New blocks have been formed, new alliances, new trust factors. India is at the center of West Asia, Europe, and in many parts can use its geographical advantage in a very strategic manner. Now, in this aspect, how will we adapt and how quickly will we move forward on this aspect? So when we look at the multilateral alignment that we've tried to already build in a very short period of time, so whether it's the Europe FTA, whether it is the $70 billion of investment that Japan has committed, our own conversations with the India-China corridor, I think a lot has happened very quickly, and that will continue, and that will shape the way we look at global trade from an India perspective. But if I look specifically at the Global South, which is what is of great interest to a lot of us, 133 countries, 62% of the world's population, 30% of all trade that happens in the world happens in this part of the world. In fact, this could be $14 billion of trade by 2033. And we are already seeing the shift in this trade happening from the more traditional minerals and traditional products being exported and imported. We are now seeing this move to automobiles, manufacturing, a whole lot of more sophisticated products that are going through the pipe. As we evolve, we're going to have to make sure that all of this is done in a more sensible manner. Mm-hmm. Why first the Global South, and what are the risks? That's what I think is on top of our mind. So why the Global South is because, one, I think logistically probably the most convenient, where you can add value. There's been a lot of investment in ports, roads, connectivity, data, a whole lot of things that can enable these corridors very easily and take it to the next level. I think that's where also a little bit more about cultural affinity, understanding of these markets, and ability to grow these at a faster pace is right front and center of the reason why we think the Global South is the next buzz that's going to happen. What are the risks? Of course, we have the risks associated with West Asia and the geopolitics of the Red Sea that are always there.
Yes.
But the short point in conclusion is, this is our corridor optionality, and we have that optionality today.
Well, you know, you're right. This is the optionality that we are faced with today. You know, I can't remember the last time we saw the Red Sea issues being talked about in the news. I mean, that's how quickly headlines are changing, and that's how dynamic the situation is. But, you know, as we talk about these dynamics unfolding, you know, from a readiness point of view, whether it's treasury, compliance, and so on and so forth, how geared up are we to make good this opportunity that you spoke of?
Yeah, it's a very relevant point. We're living through a complete global reset. In this global reset, we are seeing new alliances that are being formed. the way we do trade finance, the way we manage our liquidity, the way compliances are being done. So banking is going to change completely from what we see. So banking cannot remain completely isolated from where we've been so far. Let me start with probably trade finance. So trade will move from paper to platform. LCs will be probably digital contracts. AI can work faster than any analyst in looking at risks when it comes to trade finance. All of this is moving at such a pace that is very encouraging, and I think this is where we're all spending a lot of time. But for us, I think it's not a tech shift. This is actually a global strategic opening. When we look at Treasury and the transformation of Treasury, there is no choice. Treasury has to be 24/7. Treasury is going to be multi-currency. The dollar is not the only game in town. Even the rails provided to banks by SWIFT have completely aligned themselves to the fact that these new corridors need to be enabled, and they need to be enabled in an efficient manner that drives the requirement of each country and each corridor, which may be slightly nuanced as well. For example, in India, what we require is not what is required by some of the other corridors. Compliance. Compliance is no longer KYC. It's no longer tick the box kind of stuff. It's KYX. So know your everything. Right? So it's not only about getting all the basic paperwork in place, but it's knowing everything about everything. And I think that's again where we need technology. We need to be able to move very quickly. I'll give you an example. In the bank, we have now a FEMA chatbot, and that's able to guide customers through what's required in the nuances of looking at FEMA. So what can India do to do this? So one is, of course, digital at scale, think multipolar, which we're doing, strengthen the regulatory agility, which we heard about from some of the other panelists. And last but not the least, I think we need to empower our banks, strengthen our banks. Banks by capital, by human capital, and make sure that the regulatory flexibility exists as things change as quickly as they do. So in conclusion, I can say the map of money is changing.
The map of money is changing. You know, speaking about the dollar and whether the dollar is going to remain the reserve currency or not, President Trump has his own thoughts on what is happening as far as the global currency war is concerned. And we haven't even gotten into the space of talking about cryptocurrency and what that could potentially mean. But, you talked about raising capital offshore as well. And I think since we are discussing global aspirations as far as Indian companies are concerned, how critical is that also going to be as we play for global markets, as we play for scale?
Yeah. We should talk of digital assets, of course, but first I will answer your question. So I think the role of banks is not just one of financiers, but that of enablers. When I say that, I mean the bank needs to understand what is the structure, what is the risk, what is the capacity, and understand global financial markets for their customers. It's not a simple bring your investor and get the customer's job done. I'll give you an example that has, for example, State Bank of India has closed a $500 million bond last night at the tightest price ever. And this is just on the heels of a similar transaction they did, which we thought could not be beaten. But using opportunities and windows like this, I think that's where advisory, structure, capability, and making sure that the right risks are highlighted. And unless that is done, I think the trust coefficient that is required from a banking institution is something that needs to be balanced very well. And if that can be done, doing your business along maintaining the trust coefficient, I think then you have a win-win for everybody on the seat. Let me give you some details about what foreign banks have done in India. 40% of all M&A transactions from January onwards have been done, facilitated, I could say, by foreign banks in India. It's no surprise that almost half the ECBs, external commercial borrowings, that have been raised from January have also been done by foreign banks in India. The part that foreign banks play in connecting the international connectivity that they bring to the table, unparalleled. Again, I'll give you another example. $900 billion of custodized assets in the capital markets. 80 to 85% of that is custodized with foreign banks. Managing the risks in our Indian markets, the foreign exchange risk, 40% of foreign exchange flows go through the foreign banks, as they can backstop such large flows as well. So a very key part that foreign banks play in India today. Finally, I think technology will also play a very key role, and that evolution is well underway. Probably this is another opportunity to accelerate towards very specific requirements that we may have on an Indian context. So banks are the gateway to the world. Banks are the custodian of trust. And all I can say is that probably if we get this right, we can have a platform where we can showcase and ensure that the enhanced respect for India is at the right level.
Well, you know, you're right in pointing out that there's a lot that's changing, even as far as the perception of what foreign banks do or don't do in the country. You know, I think from a customer's point of view, from a retail point of view, that's not the space that the foreign banks are playing in, but except that that's the space that gets most of the headlines. So it's good to hear from you on the role that foreign banks are actually playing in both M&A as well as taking Indian companies global. But, you know, you talked about the map of money changing, and in the context of whether it's our current conglomerates or new age companies that are now looking at public listings and so on and so forth in this trade corridor that you spoke of, how do you see yourself as playing an enabler, the role of a facilitator, you know, driving the needle there?
Yeah, so in a corridor-driven world, many of the rules have changed. Many of these need to be enabled. So for an Indian company to access international markets, it's critical that they very quickly know the entire ecosystem that exists, like I spoke about earlier, the risks that are there, and also the regulatory framework that they need to adhere to. The multi-market relevance of the products that Indian companies have, again, you heard some of it from the previous speakers, and the speed at which that change is likely to come, I think, is also something that we are seeing on a regular basis. The second bit is that Indian corporates trying their best to internationalize can come very quickly when it comes to transparency and openness. So whether this is required by regulation or not, an enhanced level of confidence is built when transparency comes up. So capital chases confidence.
Yeah.
That's where, again, I think Indian companies can do a lot to get there.
You know, you're exactly right. I'll never forget what the former chairman of Honeywell told me. He said, capital is a coward. It goes where it feels safe. And that's exactly the point that you're alluding to. So what, let me end by asking you, what looks good at this point in time from your vantage point as far as the India opportunity is concerned, in light of the many opportunities that you just spoke of? What is Standard Chartered going to be focused on?
A lot of our customers want to exploit these new corridors, if I can use that word, want to use the opportunity. And again, it's a first mover, you know, it's a winner gets it as quickly as you can. So to help Indian corporates, MNCs, and large financial institutions in the country become corridor natives is our key ambition as of now.
Corridor natives, we have coined a new term here. PD Singh, thank you very, very much for joining us here at the Leadership Collective. Appreciate your time, and thank you very much for being a part of the conversations here this evening. Ladies and gentlemen, a big round of applause for PD Singh. Thank you very much for being here this evening.
Thank you, Mr. Singh, and thank you, Shireen. Now let's direct our conversation to the topic that is both urgent and essential: sustainable infrastructure. India has reached a major milestone with over 50% of its power capacity coming from non-fossil fuels. However, this achievement masks a challenge. Many renewable projects are getting stuck in financial and regulatory limbo. Delhi and its surrounding corridors will be critical in piloting new models for green energy, logistics, and industrial decarbonization. The building blocks are already in place. The eastern and western dedicated freight corridors are nearly fully operational, and the Harit Sagar Green Port guidelines are now live. So how do we get ports, parks, and plants to move in lockstep? To lead this discussion, may I please invite on stage Parikshit Luthra, CNBC-TV18, and to explore the path forward, please welcome Sumant Sinha, Founder, Chairman, Renew.
Thank you so much, everyone in the audience, for joining us. It's been a great evening of conversations, and we have with us a stalwart of the Indian industry, of the Indian renewable energy industry, someone who took a bet on this long ago. Long ago, I mean 2011. He left his corporate career to start his own initiative. He took a big bet, and that's what was probably required at that time if we look at India's renewable energy journey. And today, every company has to think sustainable, has to think about using renewable energy. So let's start off this conversation. And Sumant, I'd like to begin by asking you, you took a bold bet in 2011. What made you take that risk? You were with Suzlon Energy before that?
Yeah, thank you, Pariksha, and thank you so much for having me for this discussion. So, you're absolutely right that the bet, when I look back on it, was bolder than I had imagined when I was taking it. But it was clear to me even at that time when I was looking at this whole area that climate change was going to become a very important issue. And I don't know how much you all follow climate change issues and where we are. But even back then, in 2009, 10, it was quite clear to me that it would become a pretty central and defining issue of our times. And getting into clean energy was one way, obviously, of dealing with the whole issue. And I felt, in going from a corporate career and trying to become an entrepreneur, I did realize that whatever you do, you have to get in there early, and so I thought that getting into that particular sector at that time was early enough where I could, as an individual, go and raise third-party capital and build a business. To do it now is well nigh impossible because just everybody and their brother is now in our sector. But back then, I think it was early enough that one could make that bet.
Right. So give us a sense, as one of the early leaders in this space in India, what were some of the challenges that you faced?
Many challenges at that time. I think, first of all, of course, renewables was more expensive than the alternative, which was thermal energy or coal-based power at that time, which was going through its own challenges. If you recall, there was this whole issue of cancellation of coal blocks. A lot of companies had set up capacity without either coal linkage or PPAs, and a lot of the banking sector that had lent to the coal sector had suffered quite a bit at that time. And so they were a little bit wary of lending to the power sector in general. And we were, of course, a power generator at the end of the day. And so it took a lot of education to the lenders that, look, this is a different kind of sector. And this is a different kind of business. We don't have any fuel risk because obviously it's natural. And we were only doing things on the back of long-term PPAs, so that was also not a risk. But it was still very early. And so convincing and educating all the bankers, I think, was very important. The second big challenge that I found was that when, I had raised money at that time from a private equity investor, and my stake in the business was, relatively not that large as a typical Indian promoter's is. And so the second question that the lenders asked me is, who's the promoter of this business? Whose neck do we catch if something goes wrong? And I said, you're not going to catch my neck because you won't get much out of it. So that convincing of the bankers, I think, that this is they have to think of it as a standalone project finance, in the sector where they had been burnt, and raising large amounts of capital, I think, was one of the big challenges that we faced at that time. And it took a bit of education before we got banks over that hump. The second thing, of course, was that it was more expensive. So, getting buyers for it, getting the discoms at that time, who were our counterparties, they wanted to buy only a certain amount because there was some pressure from the top that they should move towards clean energy. So that was the second thing. But then, obviously, our PPAs were signed with the discoms. And discom financial health was good then, and it is still not good today. Of course, now a lot of things have changed in terms of the payment security mechanisms and so on. So we don't take direct discom risk for the most part any longer. But that was another big challenge. Right. And then, look, it was a new industry. So we didn't have any trained people. So getting people was also hard.
Yeah. Today, if people are getting into this business, new entrepreneurs, they have the broad policy goals there in place. The Prime Minister has said that we want to be net zero by 2070. We want to have 500 gigawatts of renewable energy capacity by 2030 as well. But currently, do you feel has the climate agenda, the renewable energy transition agenda taken a backseat because of the wars that we are seeing, because of geopolitical realignments, the kind of trade tensions we're having with the US? Because it seems that countries are looking at foreign policy, geopolitics, almost on a day-to-day basis. You're looking at a rare earth crisis. Possibly you're thinking, how do you go from one month to another? It's very difficult to take a long-term view.
You know, I think that's an issue that is impacting almost every business person across the world right now, because the geopolitical environment has become so volatile. And we're all looking at what's now coming, what is from one day to the other. So I think it's not just our sector. I think everybody is getting impacted by the uncertainty that exists around us. If you're an exporting industry, a trading industry, then certainly that's a big concern, right? I think as far as our sector is concerned, there are two aspects, two ways to think about it, right? One is the imperative coming from a climate change standpoint. And there, clearly, the pressure has weakened. In that, the US has obviously pulled out of the Paris Climate Accord. Now they're actively trying to push the fossil fuel agenda, which is not at all good for us as a human race and as a world. But that's what they're doing. The European Union, which is a big driver of some of these actions, has also got distracted. So they are also not moving as much as they should be right now. They're having to spend more money on defense. The whole geostrategic issue and defense issue is uppermost in their minds. But I think as far as India and China are concerned, which are two of the big drivers of our sector, I don't think anything has changed fundamentally. China continues to roll out the capacity that they were doing earlier. India continues to do the same. Now, I would say that while, of course, at a government level right now in India, the thought is obviously about how to deal with all the trade disruptions that are being caused. But I think our sector is on a bit of an autopilot right now. Things the systems have been put in place, the structures have been put in place, the policies are there. We just need to go out and keep rolling it forward. And that's really in some ways what is happening for us. So it's fine. I think we are okay.
But do you believe that the problem for leaders leading renewable energy companies right now would be, how do you get access to capital for the next phase of your growth, next phase of your transformation? I'm guessing right now, US investors would not be that bullish on India. That investment would be drying up, at least till this tariff issue is sorted out. Are there pools of capital available?
No, I wouldn't agree with that thesis, Parikshit. What we are seeing is that the public markets are obviously extremely robust right now. So anybody can raise capital at very attractive valuations. And that market is providing a lot of funding into our sector as well. But the private markets are also pretty active right now. And because some companies are going to the public markets, the amount of opportunities for them is actually shrinking. So the private markets are actually also very active. And there are many private equity firms that have announced new investments into our sector. So I don't see any diminution of interest from any investment sort of class into our sector, whether on the debt side or the equity side right now. So if you ask me honestly, I would not say that raising capital is the uppermost worry in our minds, or even I won't even link it to the word worry at all, because there's ample amounts of liquidity for us. And we did 15 gigawatts 2 years ago. Last year, 2025, FY25, we probably did about 30 gigawatts as an industry. This year we'll probably do 40, next year we'll probably do 50. So I think our sector is really increasing quite substantially, but I don't see capital as being a constraining factor.
Right. So the audience clearly knows that you took a very big bet in 2011. What's going to be Sumant Sinha's big bet in 2025 for the next 5 to 10 years?
That's a tough one to answer. As we just said, the world is a very volatile place right now. I think we just have to wait and see how things pan out a little bit. 2025 is still, no, you said 2025? 2025. So I think for the next 5 years, one of the things I would certainly look at is the whole development of the e-fuel space around green hydrogen, green ammonia, green methanol, those kinds of things. It's got delayed by a little bit, but I think certainly that's going to evolve quite substantially over the next several years. So that's an area that we have to keep focus on. Nuclear is another very interesting area that is likely to open up very soon because the government wants to attract investments in that sector and make it a regular power generating source like any other source, and remove the kind of little separateness it has right now. So I think that's going to be very attractive also. So I think those are some of the new areas that are going to evolve. One of the things that is going to become a lot more prevalent is going to be batteries and storage technology. So you'll see a lot of installation in batteries and storage tech happening over the next 5 years as well.
Right. So since the time you've started off, clearly there is so much of more awareness about the renewable energy industry and about the need for climate action and making sure that you're getting energy from renewable sources, you're reducing your carbon footprint across your supply chain as well. And these will be very essential as we start exporting to countries in Europe, in US, in UK, and in the Western world. But as of now, domestically, what are some of the challenges that you see? One with infrastructure, one with the availability of capital, which you've said is not a problem, grid integration. Could you list out some of the challenges that you see in the country that we need to overcome?
Yeah, there are, of course, several issues as well. Ours is ultimately, at the end of the day, an infrastructure sector. We do have to take very heavy equipment to sites which are in faraway areas. We have to build roads, we have to build transmission infrastructure. All of that takes a lot of effort. It also takes a lot of land. So I think clearly land acquisition is going to be one important issue that we have to solve. And I think the more people that get into our sector, the easier it will be for us to do things at a bigger scale because there'll be more people running around trying to acquire land and so on. The second is transmission build-out is going to be very critical because ultimately we need the wires. We are tethered to wires. Now, if that wire building falls behind, then all the generation capacity might get stranded. And whatever buffer in some ways we had in our transmission system has now got exhausted. And now we are very sort of on a balanced basis right now between transmission infrastructure and generation capacity. So we need to build our transmission ahead of generation capacity. So I think that is going to be something we really, really have to watch out for. Grid management is very critical as well because our grid is designed for really a different system, a legacy system based on coal-based power, based on very, base load kind of power systems or generating systems. We're not going to have that. And plus we'll have rooftop solutions which are also going to be feeding power into the grid. So grid management is very, very critical. And we need to have a whole infrastructure of people who come from a renewables background who can actually feed that requirement into grid management. So I think that is another very important aspect. And then I think as we localize the manufacturing industry into India, which is one of the government's about sort of objectives in this sector, that is going to also take some time because right now, as you know, we are manufacturing all the modules that we require. We are manufacturing now more and more cells, but then we'll need wafers and we'll need polysilicon as well to come in eventually. Wind turbines, fortunately, we make entirely in India. So there is no issue there. And then battery cells also we'll have to localize at some point. So I think that's going to be another thing that the government has to still do some work on.
Right. Now, we've seen a lot of schemes from the government when it comes to pushing renewable energy generation in the country. So if you were to recommend the next phase of policy support, what direction should that take so that all these pain points are addressed for the future? Because we cannot look at it in an ad hoc manner. We need to look at it from a 10-year perspective and ensure all these infrastructural issues are addressed.
Yeah, so the solutions are fairly prosaic. For example, in the case of transmission build-out, right-of-way problems obviously impact the speed of build-out. And so we need laws in every state that allow the transmission provider to pay whatever is required to solve the right-of-way problem, right? Not all states allow that to happen that easily. So that's one thing I think that we need. The second thing is you could argue that today transmission capacity build-out happens through two mechanisms. One is through a bidding mechanism and the other is through a direct allocation. In a direct allocation, it's more like a cost plus. In a bidding situation, the person who's won the bid has no incentive to spend any money on solving the right-of-way problems because he's getting a fixed number, right? So he wants to keep his capex as low as possible. So allocate more capacities on this on an allocated basis rather than on the bidding basis. So I think it's those kinds of issues that have to be solved. States have to try to make all land allocation consistent across all states, because every state has slightly different rules and regulations. So that has to be eased up. And then states who actually have a lot of revenue land also have to find a transparent way of allocating that revenue land. Today, not all states have the same policies. In some states, it's more transparent than in others. And so therefore, I think we need that to come in as well. And then I think, the one thing the government has to think is how to ease the demand side bottlenecks as well. Because today, it's the DISCOMs that we get the demand from. DISCOMs, as we know, are not in great financial health. So DISCOM reform is another very, very important aspect of our power sector, which has not happened despite central government trying it several times, because states are not really playing along with them. So I think one thing is to just separate the wire that goes into the homes from the company that provides the content, and just give content providing, just open that sector up. That will, I think, create a much more efficient distribution sector.
Those are some very difficult problems, and considering the structure that we have in our country, where states make their own rules, and every company which invests in India often talks about this divergence in rules. This is not going to change, Sumant, but at the same time, for entrepreneurs getting into the renewable energy or companies who've been around, how do you now stick it out and ensure that you have the right to win? How do you make the right choices amidst an environment that is unlikely to change beyond a point?
Yeah, look, I think ours is perhaps the only sector in the country where you have, if you take the top 10 business groups in India, probably all of them are in our sector, okay? And more people are coming into our sector every day. And also because capital markets are really richly rewarding our sector, therefore there's become a bit of a stampede of just set up some capacity somehow or the other and then hit the public markets, while they're still there. So there's a bit of that sort of sentiment is creeping in that just get in and do something and go forward. But, it's not an easy sector. Ultimately you have to forecast wind for 25 years. You have to forecast solar radiation for 25 years. You have to manage these assets over a long period of time. And those are not straightforward things to do. So I would tell anybody who wants to get into the sector that, look, this is hard work. It is not that straightforward. Just because I'm sitting here wearing a suit and tie doesn't mean that we're not, that we don't have to go to the sites and really sweat it out there as well. That also needs to happen. So I think anybody who gets in should come in for the long haul. Don't come in thinking that this is a sector where you can come in and make a quick buck or something. Come with a view to really building something of value. And keep in mind that these assets, once they are put up, they are there for the next 25, 30 years. And you're really involved in nation building at the end of the day.
Sumant, I was having a conversation with the Singapore ambassador, and the Singapore Prime Minister, ladies and gentlemen, is in the country right now. One area they wanted to collaborate and consider collaboration with Indian companies was small modular reactors. Their view was that these reactors can be as big or slightly bigger than this bottle, and that could power a whole neighborhood for that matter. So they were looking for those kinds of solutions, and countries and companies they can rely on, and reliable allies as well. Do you think these are the kind of solutions we need to think which are actually useful to people? Don't get into the run-of-the-mill technologies which are old. Think of things which will really help?
I'm not sure that you'll have a bottle this small powering a neighborhood. Small modular reactors are reasonably large sized as well. I don't know that those kinds of technologies are around the horizon at this point. Even SMRs will take at least 7 to 10 years before you start seeing them really get deployed at scale. But fusion, of course, is a futuristic technology. A lot of capital is going into it. Whether that eventually becomes viable or not, I can't say. But even that we'll discover only 10 years out.
All right. My final question to you would be, what's the one leadership advice that you'd like to leave our audience with, keeping in mind your own experiences, regrets, challenges, and achievements that you've seen through the course of your career?
Okay, I'll give you my general feedback on that. See, when I was working in the US, a lot of the entrepreneurs there had this attitude of you build and you flip, right? And so becoming a serial entrepreneur was a good thing. But a lot of the philosophy was about creating value for yourself and then moving on to the next thing. when I came to India, I started working with Indian promoters and multi-generational Indian promoters, and their mindset was totally different. It was just about stewardship. You were there almost like the phantom that walks. You have one after the other, so you just sort of carry on, and you just build the business and take it forward. And my philosophy is really, having seen both and seeing what our country needs, I really believe in the latter philosophy, that as a leader, you really have to build things for the long term. India needs it right now. We need a lot of infrastructure. We need a lot of really good quality companies. So I would say whatever you do as an entrepreneur, build a business for the long run. And one very important part of that is to really build a strong organization with really strong governance, strong value systems, and really great people operating in a way with each other, which is really the kind of openness, transparency that is required. Okay, so I think building an organization is something that most entrepreneurs don't realize when they're building their business, that you're actually not just building a business, but you're also having to focus on building the organization for the future as well. So I think that is an incredibly important thing to consider also.
All right, a long-term vision and a model that really helps people and finds genuine solutions. Thank you very much, Sumant Sinha, for an excellent conversation this evening.
Thank you. Thank you.
Thank you, gentlemen. As we close this chapter of the Leadership Collective, the key takeaway is clear. The future of Indian growth will be built on the back of resilient corridors, corridors of capital, corridors of trade, and corridors of talent. This evening, we've heard from the leaders who are not just talking about these new paths, but they're actively building them. Their foresight is our roadmap. On the behalf of Standard Chartered and CNBC-TV18, thank you for joining us. We'll see you in the next one. I request everyone to proceed to dinner now. Thank you so much.